Have you ever found yourself just staring at a tax form, feeling like you're, I don't know, trying to figure out some ancient code? Or maybe wondered how all those lines and numbers actually connect back to your hard-earned money? Today, we're doing a deep dive into the basic structure of the income tax formula, and we'll see how it connects directly to that form everyone gets, Form 1040. Our goal here is really just to demystify the main ideas so you can get the big picture, even if the forms themselves change a bit year to year. Think of it as a shortcut to being well informed about something that, well, impacts pretty much all of us. But before we really jump in, just a quick reminder, this deep dive uses material from Farhat lectures. All the content, examples, and explanations we talk about, they come from the great accounting resources over at farhatlectures.com. So if you're an accounting student studying for the CPA exam or already a professional, definitely check out the website. They've got extra practice questions, video lectures, tons of support to help reinforce what we cover today. A big thanks to Professor Farhat for providing this valuable material. Okay, so let's unpack this thing. Every journey starts somewhere, right? And for income tax, that starting line is something called gross income. How should we really think about this? Is it just like all the money I made, or is there more to it?
Well, it's interesting you say that because it is kind of like the starting point on an income statement. Revenue. Gross income is basically all your taxable revenues bundled together. It's the absolute first thing.
Right, the top line.
Exactly. It's like the widest net the IRS casts. It pulls in almost everything that increases your wealth, unless the law specifically says, nope, not this.
Okay, so obviously wages, salaries for my W-2, that's in there.
Definitely. That's usually the biggest chunk for most individuals.
But what else falls under this gross income umbrella? What are some common things people might not immediately think of?
Oh, good question. It's broader than you might guess. You've got interest income, for example. And here's a key thing. Even tax-exempt interest, like from municipal bonds, you still usually report it, even if you don't pay tax on it.
Ah, interesting. Okay.
Then dividends qualified. Ordinary, they have different rules, but they start here. Also, the taxable parts of IRA distributions, pensions, even Social Security benefits for some people.
Wow, okay. So it really does cast a wide net. What about things like, say, selling stock or, I don't know, winning a prize?
Yep, absolutely. Those count too. Capital gains or losses from selling assets, think stocks, bonds, maybe even crypto that goes in. That's usually detailed on Schedule D.
Schedule D, got it.
And then there's this catch-all category, other income, which you find on Schedule 1. This is where you see things like taxable state tax refunds.
Wait, refunds can be taxable?
Sometimes, yeah, if you deducted those state taxes in a prior year. Also, alimony received, but only from older agreements pre-2019. Unemployment benefits are in there too. Rental income if you're a landlord. Even things like canceled debt, which can be a big surprise. Gambling winnings.
Gambling winnings too?
Oh, yeah. Jury duty pay, prizes, awards. It's a surprisingly long list. Basically, if money came in, the default assumption is that it's income, unless there's a specific rule saying otherwise.
Okay, so we've gathered all this income into one big pot gross income. Now, I know the next step is really important. Adjusted gross income, or AGI. This is where things start getting maybe a little more refined. What exactly are these adjustments, and why is AGI such a big deal?
Right. AGI is crucial. Think of it like this. Gross income minus a specific list of deductions. We often call these above-the-line deductions because you subtract them before you get to that line item called adjusted gross income on the form.
Above the line, okay.
And AGI itself, it's like a gatekeeper number. So many other tax benefits, other deductions, credits, whether you even qualify for certain things, are based on your AGI.
Ah, so your AGI level can actually limit or unlock other tax breaks later on.
Exactly. A lower AGI is generally better because it can open the door to more deductions and credits or increase the amount you qualify for. It's a really pivotal figure.
So these above-the-line deductions are pretty powerful then, since they lower your income before you even think about the standard deduction or itemizing. Can you give us some examples? What kind of things count as adjustments?
Sure. These are usually things Congress wants to encourage or provide specific relief for. You'll find them on Schedule 1. Common ones include educator expenses, for teachers buying supplies.
Right.
Certain business expenses for military reservists, contributions to health savings accounts, HSAs, which are fantastic tax tools.
HSAs, definitely heard of those.
Moving expenses, but only for active members of the armed forces now. Deductions for contributing to certain self-employment retirement plans like SEPs or simple IRAs. Penalties if you had to withdraw savings early.
Yeah.
Alimony paid, again, for those older agreements. And a big one for many people, Student loan interest paid.
Student loan interest, okay, that's a common one.
Yeah. So you add up all these specific adjustments that apply to you, subtract that total from your gross income, and boom, you have your adjusted gross income, your AGI.
Okay, AGI calculated. Now we hit a major decision point, right? A fork in the road that impacts the final tax bill quite a bit. What's that choice?
Precisely. After AGI, you basically have two main options to reduce your income even further before taxes are calculated. You can either take the standard deduction or you can itemize your deductions. You can't do both.
Standard versus itemized. Okay. What's the standard deduction all about?
The standard deduction is, well, it's a standard amount set by the government. It makes filing simpler for a lot of people. The amount depends on your filing status: single, married, filing jointly, etc., and it changes pretty much every year due to inflation. For the year this material is based on, a single person got, I think it was $12,550.
Okay, so it's a set amount, no need to track specific expenses for that part.
Exactly. If you don't have a lot of specific deductible expenses, or if they just don't add up to more than the standard amount, you just take the standard deduction. Easy peasy.
But what if you do have a lot of specific expenses, like maybe high medical bills, or you paid a lot in mortgage interest?
That's where itemizing comes in. Itemized deductions are listed out on Schedule A. This is where you tally up specific things you paid for during the year.
Okay, what kind of things are typically itemized?
Well, there's medical and dental expenses, but there's a catch. You can only deduct the amount that exceeds a certain percentage of your AGI. So that AGI number pops up again.
Ah, okay. Limitation there.
Right. Then there are state and local taxes. You paid income or sales tax, plus property taxes. But that total is capped, usually at $10,000 per household.
A SALT cap, right?
Yep, the SALT cap. Home mortgage interest is another big one. And charitable contributions, gifts to qualified charities.
So you add all those up, medical over the threshold, SALT up to the cap, mortgage interest, charity.
Exactly. You add up all your potential itemized deductions.
And then you compare that total to the standard deduction for your filing status.
Perfect. You look at your total itemized deductions from Schedule A, and you look at the standard deduction amount. Whichever number is bigger, that's the one you use.
Because a bigger deduction means less taxable income.
You got it. You always want the largest possible deduction. These are often called below-the-line deductions because they come after AGI.
Okay, above-the-line adjustments get us to AGI. Then below-the-line deductions, either standard or itemized, get subtracted from AGI. What does that leave us with?
That leaves you with your taxable income. So AGI minus your chosen deduction, standard or itemized. That taxable income figure is the number your actual tax is calculated on.
And how does that calculation work? Is it just a flat percentage?
Usually not. For most people, the U.S. has a progressive tax system. This means different chunks of your income are taxed at different rates. There are tax brackets. So your first dollar's amount of income is taxed at one rate, the next chunk at a higher rate, and so on.
Right, the marginal tax rates.
Exactly. You apply those rates to your taxable income to figure out your initial tax liability. Let's call your gross tax liability.
Gross tax liability, okay. But we're not done yet, right? Because then come credits. People seem to love tax credit.
Oh yeah, credits are where the real magic can happen. They're different from deductions.
How so? Why are they considered, more powerful?
Okay, this is a really key difference. A deduction reduces the amount of your income that gets taxed. So a $1,000 deduction might save you, say, $100 or $220 in tax, depending on your tax bracket.
Right, it saves you percentage.
Exactly. But a credit reduces your actual tax bill, dollar for dollar.
Ah.
So a $1,000 tax credit saves you $1,000 in tax, period. Much more impactful.
Wow, okay, big difference. What are some common credits?
There are quite a few. The child tax credit is a big one for families. The earned income tax credit helps lower to moderate income working individuals and families. There are credits for education expenses, for childcare, for energy efficiency improvements to your home, lots of different ones aimed at specific goals or groups.
So you calculate your gross tax liability based on taxable income, and then you subtract any credits you qualify for.
That's the process. Taxable income tax calculation, gross tax liability, subtract credits, final tax liability.
Okay, we've made it through the whole formula, from all income down to the final tax owed after credits. Now, the moment of truth. Refund or payment?
Right, the final step is just squaring up.
Yeah.
You compare that final tax liability number we just figured out to the total amount of tax you already paid during the year.
How would I have paid already?
Mostly through withholding from your paychecks if you're an employee. Your W-2 shows that. Or if you're self-employed or have other income without withholding, you might have made estimated tax payments directly to the IRS throughout the year.
Okay, so you add up all your withholding and estimated payments.
Yep. And compare that total to your final tax liability.
If you paid in more than you owe, you get money back.
You get a refund. That's what most people hope for.
And if you paid in less than your final tax liability.
Then you owe the difference, and you'll need to send a payment by the tax deadline.
Simple as that, huh? Well, maybe not simple, but logical.
It is logical once you see the flow. Gross income, adjusted down to AGI, further reduced by deductions to get taxable income, calculate the tax, apply credits, and then see how it matches up with your payments. That's the whole journey.
That was a fantastic walkthrough. It seems complex when you first look at a 1040, but breaking it down like that, understanding gross income, AGI, the deduction choice, credits, it really does give you a much better handle on things, doesn't it? Even if the forms look a little different next year, that basic structure holds.
Absolutely. And, understanding this framework isn't just about filing your taxes once a year. Knowing why things are structured this way helps you make smarter financial decisions all year round.
How so?
Well, you can start thinking about, oh, if I contribute more to my HSA, that's an above-the-line deduction, lowering my AGI.
Right.
Or maybe if I bunch my charitable donations into 1 year, I can itemize instead of taking the standard deduction. It helps you see the tax implications of different choices and maybe even estimate your tax situation before December 31st.
That's a great point. It's not just about compliance, it's about proactive planning.
Exactly. The specific rules and numbers change, but the concepts, income, adjustments, deductions, credits, payments, that underlying structure is pretty constant.
Really valuable perspective. It empowers you with knowledge. And hey, if you want to dive even deeper, get more practice with these ideas, we definitely recommend checking out farhatlectures.com. They have tons of resources, practice questions, all that stuff to really lock this in. Well, thank you so much for breaking that down for us, and thank you all for joining us for this deep dive into the income tax formula. Until next time, keep learning.